Now you see it, now you don't. Concerns about inflation and tightening went up in a poof of smoke this week, and all it took was a few more words from Fed Chair Jay Powell. This is Bloomberg Wall Street Week. I'm David Westin. This week, Stacey Cunningham of the New York Stock Exchange talks SPACs, direct listings, and IPOs.
The primary driver to go public is no longer about raising money.
And special contributor Larry Summers of Harvard on risks in the very different approach to antitrust enforcement promised by the new chair of the Federal Trade Commission.
Any attempt to change the goal of antitrust policy, I believe, will do grave damage to the American economy.
Last week was the week Fed Chair Jay Powell rattled the markets by saying inflation was more of a concern than they thought. And so the board just might be raising rates faster than they thought.
As the reopening continues, shifts in demand can be large and rapid, raising the possibility that inflation could turn out to be higher and more persistent than we expect.
This week, the chair went to testify on Capitol Hill, and, well, he pretty much said the same thing he did last week, but this time with entirely different results.
A pretty substantial part, or perhaps all, of the overshoot in inflation comes from categories that are directly affected by the reopening of the economy.
So what was different? The fundamentals seemed pretty much the same, with economic data showing continued strength overall. The United States continued on its path to put the coronavirus behind it, while President Biden got one step closer to fulfilling a campaign promise with a tentative infrastructure deal.
It's been a very long time since the last time our country was able to strike a major bipartisan deal on American infrastructure, which is so badly needed, I might add.
And the mayoral race in the home of Wall Street, right here in New York City, wasn't nearly so much about the pandemic as it was about making sure we get those tourists back to the Great White Way.
Once we get hotels open, restaurants open, I think tourism will be back more than ever this fall.
Whatever the markets saw this week, they certainly liked it, as equities were up across the board, with the S&P 500 ending the week at another record high, joining the Dow Jones and the Nasdaq in rising more than 2%, while the 10-year Treasury added 9 basis points and the yield curve overall steepened about 10 basis points. To give us a sense of how investors see this round trip with the markets over the last 2 weeks, welcome now Barbara Ann Bernard. She is founder of Wincrest Capital, and Chris Ailman, CalSTRS Chief Investment Officer. Welcome to both of you to Wall Street Week. So, Barbara Ann, let me start with you first. We had sort of two versions of at least what the market saw in what's going on. One is, we got to be worried about inflation. It may be sticking around. The other is, don't worry about it. It's a long way off. It's not the bigger problem. Which was right?
Well, I'd categorize this market as all greed and no fear, and that's exactly what you saw this week. You know, if in finance we're taught the law of 72, which essentially means if you're annualizing your returns at 7% a year, you're going to double your money every 10 years. The PPI clocked 6.2%. That's really meaningful, because by that same math, you're losing half of your purchasing power every 11.2 years. And this is what the market really needs to be focused on. Inflation is here to stay. It's not transitory. Powell tried to paint it as this inflation rat going through the anaconda. We all see the bulge and it's moving. Don't worry about it. I disagree, because of the way inflation is calculated. It's a year-on-year number. So sure, used cars being up 35% this year may be part of a reopening trade. Lumber being up may be part of a reopening trade. And people going back and stop working on their porches, maybe why lumber's falling. But things like wage hikes, that's sticky. That's not falling. And so even if you had 0% inflation next year, that's still a 6.2% increase in the cost of goods. So that, in my opinion, is permanent. The other thing I would say is that Powell kept talking about an inclusive and equitable recovery. And what you've gone from is an administration that was obsessed with wealth creation to one that's really obsessed with wealth redistribution. That is inflationary as well. And you also look at the Biden administration, they're quite focused on decarbonization. That is going to take a sustained investment, and investment is inflationary. So for multiple reasons, I think inflation is here to stay. I think it's being underappreciated, and it's something we really need to focus on.
So, Chris Ailman, give us your perspective. You are a long-term investor. You have a lot of money to invest. You also have a lot of obligations in the out years. At this point, are you adjusting your investment calculus because of the prospect of increased inflation?
We are, and I agree with Barbara Ann. I think that inflation is here to stay, and I think that it's subtle and creeping in. The way the government measures CPI is not effective at all. But if you ask the average person, they're feeling it. They see it in prices they're paying. And as she pointed out, it's going to be a wage pull as well as a price push on inflation. So I'm not sure when CPI will really pick it up, but I know we feel it, and it's showing up in lots of different places. So as a long-term pension plan, as you put, David, with a 30-year horizon, inflation is the real threat. So we're actually increasing our inflation-sensitive assets, which is a whole basket of different things, and increasing it pretty steadily over time. We really want it to be a larger percentage of our portfolio.
So, Barbara Ann, let me ask you about something. There was a little bit of a debate this week on Bloomberg between Savita Subramanian of Bank of America and Jonathan Golub from Credit Suisse about whether an investor should take into account the ability of a company to pass on increased costs to customers. Is that doable? Because some people think it is something that is that one way to try to compensate for inflation we're expecting?
Absolutely. I mean, I think you want to invest in companies with a high inflation pass-through rate. If you look at something like Amazon, it's nothing more than a price comparison website. If you're selling white goods through a price comparison website, it's really hard to pass through those costs. You know, you also had Whirlpool this week say they were trying to increase costs, but the price of steel is up substantially. It's going to hit margins. So I don't want to be in those companies. I want to be in companies with a very high inflation pass-through rate.
Chris, let me ask a slightly different question. Another thing that happened this week was infrastructure. I mean, it's not there yet, but certainly the president announced a bipartisan agreement. It looks more likely than it did last week. I think it's fair to say that. To what extent does that affect an investor's perspective? If, in fact, we get a substantial investment in infrastructure, what does that mean for the long-term growth of the economy?
Well, David, I remember you and I talking about infrastructure a couple of years ago. You watch Washington much closer than I do. So yes, we got closer. I'll believe it when I see it. But longer term, I think it is an interesting area. We really do think that internet service is an infrastructure type of investment, broadband, and the charging stations. That's reality. That's going to be an investment opportunity. The government needs to step in and be in the first loss position, but I think you'll see private capital flow. There's a ton of capital, not just in the USA, but around the world, that's very interested in long, stable returns from an infrastructure play. And they love the USA because we have a rule of law, we have very clean rules and contracts, but they've got to see an opportunity where they can make a steady return out of it. So the USA always has that challenge in infrastructure. Municipal bonds are always the cheapest form of cost of capital to build something. But let's face it, they're not good at maintaining it. So if you want to build something and maintain it, you've got to have some private capital in there. And that's going to be the challenge with this bill, is figuring out, with all this federal money coming in, how does private capital fit in that capital stack?
Barbara Ann, what about you? Do you take into account a possibility, an increasing possibility, I think it's fair to say, of an infrastructure investment when you're doing your investments?
I was very pleased with what I heard. 19% of it is going towards EV cars, buses, grid resiliency, environmental remediation. This is all good for growth. This is all job creation, and this is going to make our economy more sustainable and more resilient. So I'm encouraged.
I'm curious, Chris, we've seen a lot of growth in 2021 so far. It looks like we're going to have a very robust year and probably into 2022 as well. Let's be honest, a lot of it's supported by monetary and fiscal stimulus from the government. What do you see in the out years? Are we changing the trend line on growth for GDP, or are we just giving a temporary infusion?
Well, David, I push back on you. I think it's almost entirely from government stimulus. I mean, look at personal income. The reality is personal income is going to go down in the fall when all these subsidy programs and unemployment benefits wear off. And people, at least out here, I'm seeing in California, having a really hard time hiring hourly workers to do jobs in restaurants and other areas because they make more by staying unemployed. But that changes in the fall. And I don't know if they're going to be really happy to go back to work finally and at less money. But I think that, the GDP has been supported. We've seen it bounce off such a low when we shut it down a year ago. But I'm worried about this fall, not just the out years. I really think that we're going to start to see some struggles and lower GDP as we come back to work. It sounds crazy, I know, that we're going back to the office, but we might have lower production levels. It's something we're going to have to work through, and I may be wrong, but we'll see.
Chris, fair enough. I was trying to be gentle in the way I described it, but you may be right that it really is entirely because of the stimulus. So, Barbara, and to wrap up this segment at least, are you concerned about perhaps a hangover from all this monetary and fiscal stimulus?
Absolutely. It's hugely inflationary. And, as Chris says, we've got to get people back to work, and you get what you pay for. So instead of extending employment benefits, maybe we need to start sign-on bonuses like the Hilton and McDonald's and all these other companies are doing. There's absolutely going to be a hangover after this great party.
Okay, our panel of Chris Ailman of CalSTRS and Barbara Ann Bernard of Wincrest Capital will be staying with us as we turn to the question of ESG investing and how it could change our world. This is Wall Street Week on Bloomberg. This is Bloomberg Wall Street Week. I'm David Westin. ESG, environmental, social, and governance investing, is getting a lot of talk these days, and lately it's getting some action as well, with the engine number one dissident shareholder group upending the Exxon Mobil board, and this week launching an ETF to take the campaign into other boardrooms as well. Chris Ailman of CalSTRS and Barbara Ann Bernard of Wincrest Capital are still with us. So, Chris, I want to start with you because you had a little something to do with this, with engine number one. Give us your sense of why you backed these dissidents and what effect you think it's going to have on Exxon.
David, we have been having engagement and dialogue with the integrated oil companies for several years now because we're really concerned about the future and it's going to be lower carbon, and these companies have to change and adjust. Exxon Mobil has just been recalcitrant. They have just ignored shareholders for several years. New York Common made a run at them, New York City, CalPERS, and they just rebuffed everybody. We felt that it's time to change at the top. When Engine One approached us and said they're going to propose an alternative slate for a board, we said we would get behind them. So when they announced in December, we came out the same day endorsing their slate. And that was intentional. And we worked behind that, supporting their effort. We weren't proxy solicitors. What we were doing was really just calling our huge network of institutional investors in all the groups and raising this and making them aware. And I think in the end, it was Exxon's own actions of adding board members, suddenly talking about carbon sequestration. They really changed their tune because they realized that shareholders were unhappy and were frustrated. And look at that stock chart. It really turned around. Now, all the integrated oils have come up, but look at Exxon relative to the others. And I think the fact that we were finally engaging with them and making some traction with management was waking the shareholders up, and they cared. And it was a huge move. So I think the announcement that we saw that they elected three board members onto the Exxon Mobil board is dramatic. And it really is going to signal a change from the top. Now their hard work begins. I don't want Exxon Mobil to become a Kodak, a Blockbuster video store, or I'll go back in my time, a warehouse record store. We want to see Exxon Mobil actually exist 20 and 30 years from now, but they've got to change and adapt to be able to do that. They can't just stick their head in oil and gas only. And I know we've received criticism of that because that's their main calling. But they can adapt and they can adjust and become an energy company. And we're going to need hydrocarbons into the future, but we're not going to necessarily need to burn them. We're going to use them for lubricants and other things. So they've got a product mix. They've got a very solid company. They have good research. I'm optimistic with a new fresh board at the top and a change of tone at the top that this company can adjust and adapt into the future and survive, as we're seeing with all the major oils having to do, to recognize the future is lower and lower carbon emissions.
Barbara Ann, what about it? You're an expert in ESG investing and something, I think, of an enthusiast for it. Is it enough to adapt, or do we need to start taking the carbon out of the atmosphere, just not putting quite as much into it?
So, Chris, what I think you did was great. And if you can change their capital allocations decisions and save your investment, good on you. That is phenomenal. But what happened this week with the launch of another index tracking ETF, I don't think is the answer. There is no energy transition without an investor transition. So ESG 1.0 was buy the index and slightly overweight tech and underweight oil and gas and charge a premium for it. So we've gone from passive ESG to what I would now call passive aggressive ESG with engine 1.0. And while it's good, and I hope, I wish them well, I think ESG 2.0 is not engine number one. ESG 2.0 is the little engine that could. And the little engine that could invest in the renewables and the copper and nickel and lithium mines that are mining in sustainable ways that are going to drive this transition. It's investing in the ESG leaders who are decarbonizing and are disrupting their models, because we do need, as Chris says, their services, but we need them with less carbon. So I don't think ESG 2.0 is about the index at all. I think it's about decarbonization, and it takes investment, not divestment. If you listen to Morgan Stanley, they wrote a report. They said we need 50 trillion to solve climate change. 103 trillion has been committed per the UN Principle of Responsible Investing, 2 times what's needed. So the problem isn't the money. The problem is it's going to all the wrong places. And so, Chris, I'm so excited that institutional capital is finally starting to work together. But now that you've got directors and now that you've got disclosure, I think the next step is using your heft to advocate for policy change. Because if you enact a tax on carbon, you're going to get the same result without having to jump up and down in the boardroom. When you change the incentive, you change behaviors.
Chris, what do you say?
No, Barbara Ann, I agree with you. I was just going to say that, I think that the key is we have been making very large sustainable and long-term investments. We've been allocating more money to more sustainable companies. What we're trying to do is to recognize that everybody, whether it's an index, and there's just still a lot of money in index funds, but that all the companies, if they want to survive in the future, have to change and adapt. They can't just stay stuck in the current methodology. And you're right, David, we've got to take carbon out of the atmosphere. We've got to change the way we get energy, the way we transport, and especially the way we do agriculture. And then ultimately certain things like, as we've talked, concrete, steel manufacturers have to find new, better ways, less carbon intensive ways to do that. So for us, it's a holistic investment, including our index, not excluding it, but including it. And it is active management. I've said for a while that I think of ESG, climate change is the one active decision people have to make, and they have to make it now. Because in the next 10 to 20 years, the world is going to radically change, and you can't just sit on an index and wait. You need to invest and make active decisions ahead of that to capture those opportunities. So we think that change is inevitable. We've got a big sustainable portfolio that we already invest over $8 billion in new sustainable solutions, and we're going to increase that over time.
So this is a truly great discussion on ESG. I want both of you to come back and have it at greater lengths because we have more to talk about, but I want to throw you a curveball right now. I'll go to you, Barbara Ann, because we now know that GameStop, that meme stock, has been added to the Russell 1000. That's just happened at the end of the week. So what do you make of these meme stocks? Are they changing the entire index investing scene?
Oh, goodness. I love to short, but I don't get involved in those. It's not a good investment, right? And so it's heartbreaking to see companies like that get in an index. We all know it's not worth what it is today, what it's trading for today. I'm not for passive investing.
So Chris, let me go back to you on this. We all know Gresham's law, right? Is this a version of Gresham's law with these meme stocks?
I think so. And where Barbara Ann doesn't like passive, we are passive. I have served on the Russell Index Committee. I serve on the MSCI Advisory Board. And I can tell you, when it comes to construction methodology, we make some basic assumptions that the markets are somewhat rational in their pricing. And that's what's very frustrating today, being Reconstitution Day for the Russell 3000, 1000, 2000. They got stuck. And I would agree, this phenomenon, this trading phenomenon has happened before. It happened in the 90s with day traders. This is more extreme. The fact that commissions are at zero and people are bidding up these stocks to silly levels, frankly, and unrealistic levels from a Wall Street valuation perspective. It's frustrating, and I haven't minded them. They're sort of a sideshow, but now it's actually impacted the index. For that to pop up all the way into the Russell 1000 index is frustrating, but it's probably a way that people can actually change the weighting and make some money on the index then this year.
There you go. I really appreciate this panel. It's been terrific. It's our panel of Chris Ailman. He's CalSTRS CIO, and Barbara Ann Bernard, CEO and founder of Wincrest Capital. Coming up, we take a look at the week ahead on global Wall Street. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. It is time now to take a look at what's coming up next week on Global Wall Street.
David, we have some milestones to mark in Asia next week. Hong Kong's national security law will have been in place for a year as of Wednesday. And on the mainland, as the Chinese Communist Party turns 100 years old, the focus will be on the July Politburo meeting, where the PBOC is expected to fine-tune its policy stance on tightening. Also, Friday will mark 4 years since the launch of the Hong Kong-China Bond Connect. Danny?
Thanks, Sophie. We're going to be keeping an eye on the outcome of the French regional election over the weekend and any impact from that. We also have a whole host of inflation data coming out for Europe, and the week rounded out by a Swedish central bank decision. Taylor?
Thanks, Danny. Of course, as we look to next week, all eyes on Monday going to be looking at the bank stocks. Goldman Sachs saying that they could be estimating $140 billion of buybacks and dividends, of course, after the banks have already passed those stress tests. That going to be key stocks that we are watching Monday. We push forward to Wednesday. We're taking a look at earnings from General Mills, of course, because food inflation has been such a big topic. Consumers are eating at home, so that should help the stock. But remember, you have to watch those cost controls given the rising expenses we've seen in that sector. Finally, Friday, it's the big day, U.S. Jobs Day. It's the jobs report. Look for an acceleration in June, though it comes off of 2 months when it has missed where analysts have been forecasting that number. Key focus, it is all about wage growth. David, that's what we're watching.
Thanks to Sophie, Danny, and Taylor. Coming up, so many ways to take a company public, from IPOs to direct listings to SPACs. Which one is right for you? We ask Stacey Cunningham, the president of the New York Stock Exchange.
The important thing is companies have choices now, and they're looking at what is the right path to the public markets for them.
This is Wall Street Week on Bloomberg. SPACs. Companies are turning to blank check mergers to go public more than ever before. Just this year, there have been more than 550 SPACs so far, which is more than all of 2020, when more than $83 billion flooded into the space.
So with the SPAC product really gaining emergence in the equity markets because of what's going on in the IPO process, is our ecosystem of clients and borrowers, our SPAC issuers, we want to make sure that we have the tools to respond to them.
But the SPAC boom is seeing some bumps in the road. A blank check company might get you public, but thus far the returns after you get the deal done haven't been all that impressive. One index that tracks SPACs is down 20% since its February high. Fading trading volumes and the possibility of tighter monetary conditions are taking a toll on companies that went public through blank check mergers.
Bubble is not just something about one stock rising. It's a concept. It's about the fact that everyone believes in some new thing, that this concept is here to stay and about to change the world. So it is, as I say, a good idea gone too far.
SPACs provide a shortcut to the stock market, which businesses seeking to go public are eager to take. On the other side of the equation, investors in SPACs have the chance to score a big gain, but know that they'll get their money back if the SPAC doesn't meet its deadline in getting a big deal done.
It evens the playing field. It democratizes access to high-growth companies. How? Because it allows retail and it allows long-tail institutional investors, folks that may not have necessarily been tier one hedge funds.
Regulators have struggled to keep up with the SPAC craze, and now the SEC is taking a closer look, at least at the disclosure issues. Investors in blank check companies give cash to sponsors before they know what company they will be investing in.
It's really making sure that the sponsor who's behind that is fully disclosing their take on it. These are very expensive, dilutive products.
Another concern with SPACs is that companies can pitch to investors based on their forward-looking financials, which isn't allowed in a traditional IPO.
It's those disclosures ensuring that the retail investors get the right disclosures and are protected and somebody's not misleading them. And secondarily, that they're participating just like the institutional investors.
So how do you know which way of going public is right for you? Well, we turn now to the woman really at the center of this process. She is Stacey Cunningham, president of the New York Stock Exchange. Stacey, thank you so much for being with us on Wall Street Week. There are so many different ways, IPOs and direct listings and SPACs now. What determines which is the best way to take a given company public?
Oh, David, thanks for having me. It's great to see you again. And we talked exactly a year ago in the midst of the pandemic when the IPO market was so quiet, but the SPACs market was really picking up, and that really started the conversation around the various ways to go public. And it depends on the company. If you want to raise money the traditional way, you might consider using an IPO, going out on the roadshow with your bankers who are holding your hand throughout the process and working to get that established investor base that you want for the long term. And that's the reason why many companies continue to choose the IPO process, is they want to choose that investor base through the allocation process. If you want to have more control around timing and price and work with a counterparty, a SPAC might make more sense for you as an issuer. And so there's less dependency on market conditions with the SPAC process. You have a little bit more control. And then a direct listing really takes the elements of democratizing access to that first day. All investors are on a level playing field with a direct listing, so retail and institutional alike can just enter their interest, and the market prices that opening. And so if you're focused on cost of capital and having equal access to all investors, that's been a real driver for many of those companies choosing a direct listing. Another element of the direct listing that's been interesting to companies is being able to provide forward-looking guidance. And so if it's a company that wants to talk about their future projections, they've been able to do so within a direct listing. They were also relying on that within a SPAC, but the SEC put out some guidance in April about the warrant accounting in SPACs and about that future guidance, because it wasn't, companies have been relying on a safe harbor provision that is typical for mergers to be able to provide that future guidance. And the SEC said, wait a minute, that might not apply here, because as a SPAC, you're really becoming a public company for the first time. And so those were elements that are being slowed down the SPAC market a bit, and you're starting to pick them up. The important thing is companies have choices now, and they're looking at what is the right path to the public markets for them. At the end of the day, no matter which path they choose, they become a public company, and investors are going to price their stock in the public markets exactly the same way.
We heard this week from the SEC chair, Gary Gensler, raising some questions about disclosure, particularly on compensation for the sponsor of SPAC. Do you expect that it's going to get harder for SPACs as time goes on?
It's going to be really important that SPACs are providing information and transparency into how they're structured so investors have that visibility. Our markets, and one of the things that make our markets so strong here in the United States, is we do provide transparency and disclosures that lead to stronger investor protections. And so that's where we're going to see some advancement in the SPAC space as they become such a popular way to go public. Who would have guessed that in 2020, it was going to be the record year for raising capital in the U.S. markets. I mean, we blew away prior years. And in 2021, we've already surpassed the amount of capital raised in 2020. And a lot of that was driven by SPACs. So it makes a lot of sense for the SEC to look at whether or not there are additional protections and additional disclosures that might be appropriate in this market.
And I've seen reports that this summer we're going to see a lot of, I believe, IPOs.
We are. We're seeing, companies are going public all three of those ways. So we have direct listings that have come to market over recent months, and we have more in the pipeline. We have IPOs on both sides, and we have SPACs on both sides. So we're continuing to see companies tap into the public markets. And I think there are a few different things contributing to that pace and that trend. One, if you rewind a year, it was very clear that the public markets are much more efficient than the private markets in the midst of the pandemic. When the going got tough, the public markets were still here for investors to be able to raise capital. They got a little bit more expensive in the private markets. Two, as markets and money was flowing, so there's been a lot of interest in providing that capital to growing companies. And companies also were seeing how well that new companies coming out to the public markets were being received by investors. So there's a little bit of you not wanting to miss out and whether or not that window might always be available. So companies who were thinking that they might want to go public in the next 2 or 3 years are thinking, well, maybe I'll do it now because conditions are so good. It's not too dissimilar from some of the trends we're seeing in the real estate market.
One of the things that has been covered quite a bit is Bill Ackman's SPAC, and that now is apparently going to invest in part of Universal Music, part of the Vivendi Group as they go public. Is there a problem with this because people thought that he was going to spend all the money on one big deal, and now it looks like it's not going to work that way?
One of the elements of a SPAC is that investors get multiple times to choose and to vote. So they can vote on whether or not they like a deal. They can redeem their shares if they want and get their money back. And so that's one of the important things that I think is really different about a SPAC. When you invest in a SPAC IPO, it starts a clock for 2 years that the sponsor needs to go out and find a company that they plan to acquire. And in those cases, those investors are largely investing in the leadership. They're investing in that management team because they're confident that they're going to find a business to invest in. But then they get a choice to vote on yes or no on that investment and to vote to get their shares back. So they can get their money back with interest. And so investors have that control, which is a unique element that's not always completely understood about the SPAC.
Give us a sense generally, because you would understand this, Stacey, of the shift back and forth between private and public companies. There was a time in which it was thought that actually more and more capital was going into private companies, particularly because of the unicorns, some of the success perhaps in Silicon Valley. Is that shifting back?
We're still seeing a lot of investment in private markets, and that's part of why companies are waiting so long to go public, is the primary driver to go public is no longer about raising money. They were able to raise money in the private markets. So the other reasons that used to be secondary and tertiary benefits of being a public company, things like liquidity for your investors and employees, or currency to engage in M&A, or that credibility and visibility that comes along with a public offering, those used to be ancillary benefits to being public. They're now the primary drivers for companies to go public because there is so much access to private capital. And David, I will say this is a concerning trend because that means that those companies are waiting to tap into the public markets until they're already large established companies. And their fastest growth years are happening in the private markets, which means not all investors have access. So our capital markets have been such an important part of the growth of this nation, but they've always been a story of shared success. And in recent years, that success isn't being shared until later in their life cycle. And so I do think it's important to see companies getting out to the markets sooner. That trend has reversed a little bit through the SPAC process, and frankly, because a lot of SPACs are talking to companies that are still private, trying to encourage them to go public, which is leading a lot of companies to think about their public market plans a little bit earlier in their life cycle. We want to encourage those trends, but we want to make sure that those companies are public market ready. And that means ready to have the disclosures and the transparencies that deliver the investor protections that are so unique to the U.S. markets.
Thank you so much for being with us on Wall Street Week. That's Stacey Cunningham. She is the president of the New York Stock Exchange. Coming up, we get the take of our special contributor Larry Summers of Harvard on antitrust policy and whether the Biden administration just might be headed in the wrong direction. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. And to wrap up the week, we're joined once again by our special contributor, Larry Summers of Harvard. So, Larry, we've had a lot of infrastructure weeks over the last few years. Maybe this one really will be infrastructure week because President Biden came out of the White House and announced a bipartisan agreement, at least on a framework on infrastructure that has about $580 billion in new money. What do you make of what was agreed to?
I was glad to see it. The investment's overdue. The investment will strengthen our economy. The investment will help support employment of groups that have had trouble. The investment will show that America's able to come together and do things. And the investment was paid for. I was particularly gratified to see for the first time a bipartisan congressional agreement recognizing that if we do what we need to do as a country and enforce the tax law better, give the IRS the resources it needs to go back to the strength it once had, that we can raise meaningful amounts of revenue.
At the same time, Larry, we quickly learned that it's a one-step and a two-step process. There's a little bit of ambiguity here about that second step, but certainly Nancy Pelosi, the Speaker of the House, said we're not going anywhere with this agreement on bipartisan bill without having the more partisan approach that has the other part of infrastructure, what the White House calls the family part of the infrastructure. How essential is that second component?
Look, we need to make human investments in this country. We need, above all, to be investing in early childhood education for our kids. We talk about STEM, but how can our kids believe we're serious about STEM when huge fraction of the chemistry labs in the country have air conditioning and heating systems and air systems that don't work? So we need more investment than is in this bill. This bill is a beginning. It is not an end. And so the aspiration to much more is, in my view, completely correct.
Larry, as a renowned macroeconomist, put this in a larger historical context, if you would. I mean, this country and its economy have been through something it's never seen before with the pandemic and the shutdown. It's bounced back fairly strongly. We also have a president who is putting forward quite a few economic plans, several of which seem to be working. How profound is the change in our economic policy going on right now? And what does it say about this country?
David, I have always believed that America's great and distinctive strength is its capacity for self-denying prophecy. Things go badly, Americans worry that the American experiment is over, that democracy is no longer working, that our government isn't going to be there. That goes back to Lincoln in the Gettysburg Address, talking about government by the people, for the people remaining on this earth. You saw those kinds of prophecies during the late 70s, what people refer to as the malaise period. You saw people saying that the Cold War was over and Japan had won. It's a recurring theme in American history that people prophesy doom, and then those prophecies are denied by actions that are being taken.
Larry, this may have been infrastructure week, but antitrust is a near runner-up as a practical matter. We had 5 bills get through the Judiciary Committee about fundamentally redoing our antitrust laws to really go after, I think it's fair to say, big tech to a large degree. We also have a new chair of the CFTC, in Lina Khan, who has made a career thus far of really challenging some of the big tech and more fundamentally the antitrust approach, the overall approach to the question. What do you make of this? Do we need to be rethinking our antitrust approach in light of what's happened with big tech?
I'm halfway with the critics. A new economy needs new thinking and new approaches. The old concepts weren't designed with issues like platform companies in mind. But I part company completely with the legal scholars, scholars who, frankly, in many cases are not very familiar with economic reasoning in its intricacy, the people who call themselves neo-Brandeisians and want to go back to what Justice Brandeis said in 1916. Ultimately, an efficient economy that serves consumers well is the right criteria for antitrust policy. Any attempt to change the goal of antitrust policy to be protecting competitors rather than protecting competition, I believe will do grave damage to the American economy. So yes, we need new approaches, possibly new laws, but they need to be ultimately grounded in an economic approach that is based on having a more functional and efficient economy. And the idea that big is bad per se, or the idea that big should be broken up just so that smaller companies have a better chance to compete even when they are less efficient. You read the traditional antitrust decisions of the 1960s, and they are a horror show in terms of their economic illiteracy, where companies make efforts to defend themselves by saying that they're inefficient and therefore they're not going to win out over competitors in competition. That is the way to American failure.
So, Larry, let's conclude with a quick round of summer says here. Number one, we had Janet Yellen, the Treasury Secretary, go up on Capitol Hill. She was testifying on her budget, actually, and she said she's fairly confident that inflation would be back down under 5% by the end of the year. What was your reaction?
Gosh, Dave, that anybody was talking about 5% would have been inconceivable 3 or 4 months ago when the consensus was in a completely different place. My guess is that at the end of the year, inflation will, for this year, come out pretty close to 5%. And it would surprise me if we had 5% inflation with no effect on inflation expectations. It could go either way with respect to 5%. I'd be happy to take the bet on over at 4.5%. But I think the real comment is that it was only 3 weeks ago when acknowledgments that inflation would reach 3% this year were treated as significantly newsworthy. So this is in line with what I have to say I have predicted on your show almost every week, that inflation is going to surprise on the high side relative to expectations, and I'm afraid that continues to be my view.
So, Larry, while we're on the second half, looking at the second half of the year, let's talk about markets overall. What are you expecting? More turbulence, less turbulence?
I think more. The crisis, in some ways, that I grew up with was the Japanese bubble in the late 1980s. And what was interesting was that there were a lot of people who were anxious about the Japanese market, and then it survived and it kept going and kept rising, and then more people got anxious and it grew. And at a certain point, most of the anxious had thrown in the towel, and that's when we had really an epic financial collapse in Japan. And Japan's market isn't anywhere near back to where it was 30 years ago. I don't think we're going to get anything like that in the United States. But I think there's a point there when worriers have been disproved a few times and people are saying we're in a new era. That's when you need to be very careful. So my guess is we'll see higher rates over the next 6 months in the second half of the year. And with those higher rates, there'll probably be more turbulence.
And finally, our final summer says here, Larry, what about the labor markets? Because some people are saying, come October, come September, we're going to fix the labor markets because people will come back off the sidelines, they'll fill those jobs, we won't have the same problem. What do you expect?
Look, we're going to see more supply as benefits wear out, as kids go back to school. But we're also going to see more demand as the economy surges through the summer and continues to open up. I'm not sure which way that balance is going to change. My guess is you're still going to have considerable inflationary pressure in labor markets for quite some time, and that's part of why I'm nervous about the inflation picture. I think that here's maybe a thought to conclude on. Policymakers say there's transient inflation. They are obviously right. But inflation right now is running at 6%. Nobody thinks that we've got that ingrained. The question is whether most of the inflation is transient or whether transient inflation means we're going to come off that 6%, but still be at too high a level. That's where my money would be.
Okay, thank you once again to Larry Summers, our special contributor, and of course, he's a professor at Harvard. Coming up, one more thought on bringing back New York, the heart of Wall Street. This is Wall Street Week on Bloomberg. Finally, one more thought. And this one hits close to home. New York is, after all, the home of Wall Street, that location in Lower Manhattan named for a wall the Dutch built in the 17th century to keep out the British and pirates. And let's be frank, I'm not sure how successful they were on either of those. New York has always been centered in business and in commerce. It's always been open to the world, particularly the commercial world. And so when the pandemic hit and commerce and imports, whether of goods or of tourists, shut down overnight, New York was hit particularly hard.
We care about the things that most citizens care about: public safety, education, and the ability of the city to attract jobs and young people.
This week, New York took an important step toward coming back as it gathered at the polls for the first time since the pandemic.
An election as we are coming out of COVID, an election in the aftermath of the greatest crisis New York City's ever faced.
This first post-pandemic election was to choose the candidates for mayor and comptroller and the rest of the city leadership. We don't know the results yet. We won't know for some weeks to come because of that ranked choice voting we've learned so much about. But we do know that Wall Street will have a new mayor, and one that sees the enormous potential for growth.
I'll rebuild our economy while tackling violent crime and bring New York back.
To recover from the pandemic, we can't just wing it. I have a plan to build a healthier, more livable city.
So once again, it's time for New York to reinvent itself. And whatever our political persuasion, global Wall Street has to be rooting it on. That does it for this episode of Wall Street Week. I'm David Westin. This is Bloomberg. See you next week.